All right,
You
welcome
want to get started?
everybody. Yeah, go ahead. Why don't you go ahead, Rob, and take from the top?
Yeah, again, thanks, Buddy and Mark and Gretchen, the entire team for giving me this forum just to talk about the changes we made to MoneyGuard. For most of you, know MoneyGuard forever. Uh, it's been 37 years that the product's been on the shelf. Just this past August turned 37. Quite a bit of changes. I mean, we think back 20 years ago, we were still ordering medical records and doing paramed exams. And then we moved to the streamlined underwriting, and that's brought competition in, which is in the end a good thing because we get more folks insured, and it's pushed some of the flagship long-term carriers in the space like Lincoln and One America to make enhancements, and that's good for everybody. It's good for the end consumer. Uh, and I also recognize that MoneyGuard's not going to work for everyone. There's going to be niches where we're going to be really competitive. We've put our flag down and say, this is the business we want. And if some clients looking for something else, then the good news is there's lots of options. So to take a step back to even last year, MoneyGuard, coming out of COVID, we had repriced during COVID, took a more conservative stance as far as our pricing at that point, been in the market for 30 plus years, said interest rates went down. We're going to take a step back so we can be here the next 30 years. In the end, that's a good thing for our policyholders, but it also opened up the door to some of our competition, our peers in this space. And they, in the end, had more eyeballs on them, and companies like Nationwide and Securian thrived during that time. Lincoln last year, January of 2024, went back, looked at the pricing, and were able to come back and reprice, and on average improved our pricing by about 15%, up to 22% in some cells. And we targeted the pricing where, and I'll show it to you here in a few moments, where we're looking for specific benefit periods, inflation, and payment durations. So in the end, you're going to see we're going to be most competitive in 4, 5, and 6-year benefit periods, specifically the 6-year with a 3% compound. With our pricing, and I'll show you the page, you'll almost never do no inflation with Lincoln because the plan with inflation actually starts out with a higher monthly benefit than no inflation. I know it seems backwards, but we just didn't reprice those plan designs with no inflation. So fast forward, Lincoln, you're really competitive. In most cases, we're at the top of the spreadsheet. If we're just flat out spreadsheeted like term, hey, I'm putting in 100,000 or 10,000 for 10 years, Lincoln's at the top. But what's different between a Lincoln and a Nationwide and a Securian? Well, there are indemnity options and there are reimbursement options. And Lincoln, a long time been the reimbursement option, the main reimbursement option in the market. But what we wanted to do, and we kind of dipped our toes into the indemnity space about 3 years ago with our FlexCare Cash, and that offered up to 50% of an indemnity benefit, but it was only available until the death benefit was exhausted. So hearing from all of you and all of our agency partners, we made the change to offer an indemnity option. I'm not going to have a PowerPoint. I'm just going to share some attachments. They're all going to be available to all of you. Let me go ahead and share screen 2 here. So let's start here. So obviously this is a new one-page flyer. We were consistently asked, Rob, we should have a one-pager on MoneyGuard that wasn't a whole brochure. Just talked about it, hey, leverage, legacy, liquidity. This is a one-pager we have now available about MoneyGuard. It is client approved, and that's really what we were being asked for, and a one-pager on the concept here. the significant we made two significant changes to MoneyGuard Fixed Advantage. So the product itself is called MoneyGuard Fixed Advantage 2025. So if you're using Insight or WinFlex or Design It or whatever platform you're using to illustrate, you're going to want to look for MoneyGuard Fixed Advantage 2025. As of a couple weeks ago, this version of MoneyGuard is available in 48 states. It's only not available in California, and we don't do business in New York. But the other 48 states, Fixed Advantage is available in. So the real difference in the plan and the one that is the sizzle is that we now offer the option of indemnity or reimbursement. This is, again, a piece that we have on indemnity reimbursement. But we've broken out on the back page to a decision tree. How it works is once you get to the time of claim, at the time of claim, not at the time of application, you will choose whether you want a reimbursement style policy or an indemnity style policy. Certainly all of you are LTC experts on this call and know there is advantages to each type of model. If you're going with reimbursement, I will say the vast majority of folks choosing reimbursement do set it up on a direct bill. They fill out an assignment of payment, and that care provider bills Lincoln, and Lincoln pays them. For those folks that, hey, I'm going to have qualified care, I want to stay out of the billing process, I like the idea of my assisted living or home care provider billing Lincoln and Lincoln paying them, great. If that's your cup of tea, that's available to you. If you believe, hey, I would rather have an indemnity style payment. I recognize I'm responsible for the bill keeping, but I'd rather just have the money sent to me and use it however I want. That is now an option with Fixed Advantage. How it works, and it will sound a little similar for those of you that have been in this space for a while, to the old Pac Life Premier Care plan. It had the 80% indemnity option on it, and that's what this does. If you choose indemnity, your monthly benefit will be 80% of your reimbursement monthly benefit. The key difference there on the Pac Life plan is that 20% went away. You lost that 20% if you chose the 80% indemnity. With Lincoln, you don't lose that 20%. It stays in your benefit pool. So in this example, a hypothetical example, whether you choose indemnity or reimbursement, hey, my pool of money is exactly the same. It's just if I choose reimbursement, my monthly benefit's $16,000. If I choose indemnity, it's $12,000. You say, well, if I go with the indemnity route, Rob, you're saying I don't lose it. How does that impact my plan? It just extends out my benefit period. So that 6-year plan becomes a 7.2-year plan. So all it does is just we stretch it out a little bit, and then you have those options. If you choose indemnity, you'll have then 3 options. You could choose that 80%, or you can elect the IRS per diem limit, or they could do something else, a policyholder choice. They have those 3 choices if they're going with the indemnity route. But the key is the pool of money is the same. They don't need to make this decision till the time of claim. But whatever you choose, and I know there are folks on this call that I've had this conversation with, it is irrevocable. So you're choosing one or the other. Keep in mind with MoneyGuard, we're the only option in the market that has a true 0-day elimination period for all benefits. So I get to the point of claim, which is the most critical, and I get to say, I don't have to pay an elimination period, and I get to choose between reimbursement or indemnity. And like I said, in most cases, I'm going to offer a higher monthly benefit and a bigger pool of money. So if the biggest pool of money and that option of indemnity, Lincoln's going to show really favorable on that 1 to 10 payment duration. Obviously, I know One America's got their lifetime benefits, and there's Care Matters Together for those joint life that want to do the shared 8 years. Our sweet spot will be that 1 to 10 pay. males and females, but more often than not, that 6-year benefit period.
Rob, just one question in the chat.
Yeah.
Sorry to interrupt.
Yeah, no, good.
Lynn had asked a good question about, I know you said it was irrevocable, but what happens if they change care setting? Can they
It's still
switch at that
irrevocable.
point? Okay, thank you.
Now, there is another carrier, One America on the market that offers an indemnity reimbursement option, but theirs is only on the AOB and it's 75%, where this is on the entire pool of money, but it is irrevocable. But at least I would rather have the choice than not have it at all. So
That's
that's
nice
one
that you
thing.
can choose that point of claim as well. So
Yeah,
you know what your situation is when you're making that choice.
Rob,
exactly.
if I'm sorry, but it's your revocable, say for home care, which is fine. But then if you go to facility, you might not want the cash. You might want the reimbursement.
Right.
So can you switch when you move to
You
a
can't
facility
switch at that
at
point.
all?
No,
All right. Thank you. Oh, sorry.
that's okay.
So,
The other change that we made, and we saw it often where hey, Rob, these other carriers offer, they break out the life and the LTC portions of the premium. Whether they're looking to use their HSA account to pay for a portion, or they're looking to deduct it, or they have a C Corp executive benefit opportunity. Lincoln never separated out the life and LTC portions of the premium. That has now changed now, and I'm going to show you exactly where to find that. But this piece is new as of last week. Lincoln split premiums with Fixed Advantage. It'll walk through tax treatment for individuals, business owners, C Corps, S Corps, non-business owners. All of that, this piece had been in the works for a while, but I'll make sure, Mark, that you have, and Mark and Gretchen, you have a copy of both of these. But this is a brand new piece and will help with that opportunity, because I don't think we lost a ton of business because we didn't break out the portion of the premiums. But this is, again, an opportunity. I will tell you, I've worked with an agency out of North Dakota that was going down the route of an executive benefit plan for 6 key executives. We couldn't participate in that opportunity or even compete for that business until this change. And now I'm getting all 6 key executives and 4 of the spouses. I just wouldn't have had that opportunity prior to that.
Rob, that's awesome that you made that change. I think it was a long time when you didn't have it that way, and finally it has come. So
yeah, finally. You know, and again, these are hearing feedback from all of you. Hey, we wish you had indemnity, and I wish you had broke out the life and LTC portions.
Awesome.
You know, the trade-off is also you have a 0-day elimination period. If I can give you a higher monthly benefit, again, we're not going to be all things to all people, but I think we're going to be in a strong position. I wanted to show you this piece because this is new too. Folks are always asking, tell us more about your claims history. How much have you paid in claims? Where your claims have been paid? We have 237,000 in-force MoneyGuard policies. We paid out $562 million in claims, 119 just last year. 76% of our claims were for females. Our average age was 83. Our longest continual claim was 9 years and 8 months. This was the breakdown of where our claims were paid last year. And keep in mind, after almost 37 years at that point, we got a pretty significant book of business. So only 10% were nursing homes, 43% were assisted living or residential care, 47% were home care. Top reasons for claim, cognitive, 60% of our claims were cognitive claims last year. And you can see the breakdown here, but I'll make sure you have a copy of this too.
It's a great piece. One other thing kind of related to indemnity benefits and the claims, Phyllis had asked, can you discuss what you do for international coverage? Because as you get into indemnity, that becomes
good question. So whether you choose indemnity or reimbursement, it's 3 years, 3-year benefit period. With ours, it has to be in a nursing home or assisted living. for that. In fact, let me pull up this piece here. I'm going to send you this piece too, because I think it's helpful. I know there are folks on the call who always ask me for this. This is our fixed advantage scorecard. So this shows Lincoln versus our significant peers in this space. It'll show you the type of policy, when the policy was launched, elimination, so on and so forth. If I scroll down, it's just a 2-page piece. Here we get to international benefits. You can see 36 months. It was a nationwide, 100%, and ours is 100% of the max monthly. Theirs is on the acceleration portion only. Securian is on the acceleration and extension, but it's 50%. So ours is full monthly benefit if you choose reimbursement. If you choose indemnity, it's the 80%, but you still need to be in a nursing home or assisted living. So it still needs to be in a facility care setting, but you can choose between reimbursement or indemnity. And I guess the only reason I probably use indemnity is if we were in an international setting and the cost of care was significantly less than the 80%. Hey, you know, my monthly benefit was 10,000. Cost of care here in Thailand is 5,000. Oh, I can get the 8,000, use it however I want. I'm going to go that route. It's for 3 years, but you can do reimbursement or indemnity. And it's a good question by Phyllis. So what I also want to do is on the illustration is show you exactly where to find some things. So on the illustration, I ran a 60-year-old here in Minnesota. Right here, you're going to see the premium. Here, you're going to see the breakout. So you don't have to hunt and peck. Where's the life and LTC portion? You're going to see the LTC portion here and the life portion here, right below it on the main page. You're also going to see the initial reimbursement monthly benefit and the indemnity benefit. And then on the illustration, I ran an alternative point at age 85. Here's 15,245. Here's 80% of that, 12,196. There are 2 other minor changes that a lot of folks won't notice. On the older version of MoneyGuard, you often started out with a higher monthly benefit, and then it would tear down in year 2, 3, 4, 5, and it would level out at say 7, 8, or 9 years. And then it would be the death benefit would be the same. In most cases on the new plan, the death benefit's going to be level in all years. So in this case, you put in 100,000. In year 1, it's 174,000, and year 90, it's still 174,000. Okay, so the death benefit's going to be the same. The other difference is the target premiums for compensation are going to be higher on this plan. For example, the target premium on the old plan for the same age would have been about $10,000. Okay. Target premium on this same plan, you're going to find it at the bottom of every page. Right here, you're going to see target premium 11,000. So in most cases, the compensation is going to be about 10% more on this version of Fixed Advantage than it was on the old version. And I know a lot of people like to do this for free. I think most of you still like to get paid. I like to get paid 10% more. That's going to be 2 minor differences that most folks won't notice. Is that in most cases the death benefit stays the same and the target compensation is a little bit higher.
I like the secret code at the bottom of your illustration. That's
yeah, the secret
clever.
code. This is one other piece I want to show you. For some of you, this might be new. I've been getting asked more and more about this, and I wanted to show it to all of you. This is on our resource library, but so many of you I can see on this call are LTC experts. You have your own protocol on how you, if you present long-term care and they decide not to move forward, you have a plan. In the old days when I started Allianz, 25 years ago, you know, we recommended a hold harmless letter, or there was a long-term care waiver. I've decided not to move forward. And it, in a way, I probably didn't think of it then when I was 26 and young, like, now it seems like you're just trying to protect yourself. What we want to do is, and we've gotten good feedback on this, is have a one-page piece. It says an asset identifier. So for those folks that said, hey, long-term care might not be the right play for me right now, but it's important for everybody to have a plan. Whether it's a loved one's providing care or I want to go here. So we created this one-page piece, and it says, you know, you put their name. Hey, I've reviewed and discussed the risks of a life-changing event such as an extended need for care. What we want to do is two things that are important on here. Make sure they know what the cost of care is. And I don't care if you use the What Care Costs website, the Genworth Cost of Care, the Mutual Omaha, I don't care what you use. Make sure that they know what the cost of a home, assisted living, and nursing home, and you can put whatever source that is right here. Okay? Again, I don't care what you use. Put the date, address, phone number. But you've informed me that you like to self-insure against extended healthcare using the following assets. And this is what I like about it. You said, hey, long-term care, MoneyGuard isn't right for me right now, or Nationwide, or whatever it is, Mutual Omaha isn't right for me right now. But what we're going to do is identify that if something were to happen to me and the kids call the financial advisor and say, hey, does mom or dad have a long-term care plan? You can say, no, we had that discussion, but the good news is we've already identified how we're going to pay for this. You know, right there, we've put the account name, the type, the value, and the account number. We have a plan. So like my parents happen to have a John Hancock LTC plan, but if I call their financial advisor and I'm thinking, oh man, how are we going to pay for this? Good news is we've already identified these accounts. And it says we will continue to review your plans to self-insure and how changes in your life may impact your financial future. So we've had this piece for about 5 years, and I consistently get good feedback from advisors and agents that say, hey, I bring this out on annual reviews or semi-annual reviews. And we just say, hey, last year we talked about extended care planning. And you had indicated you want to self-insure that. Is that still the plan? And it may still be the plan. And if so, are these still the accounts you want to use? And maybe it is, but maybe they took this first account and bought a pontoon with it. Let's update this. Or they bought a lake home. Let's make sure this is updated. Or it's led to, and I hear it all the time, that's right, you talked to us about that nursing home plan last year, right? Yeah, I remember that. Bob's mom just went in the memory care facility. Can we still get that? So to me, I look at this as really a non-threatening way. I'm not shoving another illustration in their face and let's talk about long-term care insurance again. Hey, is this still the plan? And maybe we revisit looking at a long-term care plan. Bob's mom went in and they're charging $12,000 for the nursing home, or, you know, my mom just went in and it was $18,000 for memory care. So I look at it as an easy one-page piece. Take it, make it your own. If you want to take this and make it your own, do it. But again, I've gotten consistent feedback. They like it. It's non-threatening. So I wanted to share something with you that I found to be working in the field. And I think this is a good one.
Yeah, I really like that concept too. You know, especially if you're an advisor working with an advisor, you just put it in the file. And it's always a reason to do a review later, like you said. Hey, is our plan still the same? Great, let's move on. Wait a second. No, I had to take care of mom and dad, like you were saying, Rob. Let's talk about that again. And I think that's a great way to revisit, because it's always about timing, right? When it comes to
Right.
care planning.
And I like it. It's just asset identify. We're just going to identify how we're going to pay for it. It's not long-term care waiver. It's not, you know, we're not trying to scare them. We're just, hey, this is. So the last thing I want to do, and again, my peers in this industry, my friends at Nationwide and Secure and One America, used for work for One America, all good carriers. Each one has its own niche. But what I wanted to do is show you where the new Fixed Advantage compares. And what I've done is I picked 2 peers, and it probably won't take you very long to figure out who the peers are, but I'm not here to put another carrier on blast. But I put in 2 of our main peers in this space, and I put the same annual premium in for all 3 of us. and I put the same plan design, 6-year, 3%, $100,000 premium. Obviously, the difference is I'm not requiring you to pay a deductible. 0-day elimination, you can all figure out who this is right here with the retroactive. Here's our monthly benefit. We're at $7,200. Competitor 1 is at $6,489. Competitor 2, $6,385. Our indemnity, again, 80% of this number. Fast forward to age 85, my monthly benefits about $1,700 more than competitor 1 and almost $2,000 more than competitor 2. Keep in mind, if they have a 90-day elimination period, even if they've chosen indemnity with Lincoln, we've paid out $36,600 of cash benefits before they've gotten a penny from either of these other two carriers, because we had that true 0-day. So, and if they elect to do a reimbursement model, hey, we're moving mom right into assisted living. Cash indemnity doesn't help me. I'd rather just have the assisted living bill Lincoln. Then my monthly benefit's quite a bit higher. I gave you $15,000 from day 1. Competitors 2 and 3 were $13,000. So I gave you more benefit from day 1. Now you say, well, indemnity, Rob, is the most important thing. Okay, well, let's look at the total pool of money. My total pool of money, if we look at the same benefit period, same premium, about $130,000 more than this carrier, and $150,000 more than here. So I gave you a bigger pool of money. I gave it to you sooner, and I gave you the choice of reimbursement or indemnity. And if you pass away and never need long-term care, my death benefit was bigger. Now, if they want to, it's an executive benefit play. In fact, I just had a call. My 2 o'clock call today was an executive benefit for 6 executives out of Troy, Michigan. My portion of the LTC premium is $85,000. The other 2 competitors are $45,000 and $33,000. My portion of the LTC premium is going to be bigger, and I'm going to have more. Plus, we didn't even talk about it, but I'm going to also give them the choice on what to do with the death benefit. With our benefit transfer rider, we talk about choice at the time of claim, choice at the time of death. These are individual plans. But with MoneyGuard, let's say the husband dies, never needed his long-term care. She will have the choice to either take the death benefit or roll that back into her own MoneyGuard policy, or do a little of both. She could say, you know what, it was $100,000 death benefit. I like to use $40,000 to pay for the funeral and maybe take the grandkids to Disney. I could take that as a death benefit, and I could use the balance of that death benefit to enhance my own policy. Now, the real value here is you don't have to make this decision until your spouse passes away. Okay, so choice at the time of claim, choice at the time of death. If they decide to enhance their own policy, it's more than a dollar for dollar leverage. So if, let's say, she says, I don't need the death benefit now, I'd rather enhance my own MoneyGuard policy. We'll take that $100,000 death benefit and add $107,000 to her death benefit. We're going to allow her down the road to make it a second to die, rather than deciding at the time of claim a second to die was the best option for me. So we'd add $107,000 to her death benefit, plus we'd take that $100,000 death benefit, leverage it by about 60% for long-term care. So we're going to add $160,000 to her bucket of money. So these 3 options, it's called benefit transfer rider. This is built in. And I think where the real value is of it is most people will probably take the death benefit. Now, why would you choose to enhance your own benefits? Because there's no underwriting if you elect to do that. Meaning that surviving spouse could be uninsurable. They could already be on claim with MoneyGuard. They could have Alzheimer's. and they could get more long-term care benefits at no cost. So the ability to add more long-term care down the road, I think having options is a good thing. We also don't limit this to married couples. So I just had a situation, and I was actually not just last month in the Jetter office down in Nebraska, and it just happened the day before. We had a 70-year-old female that was buying MoneyGuard. She was buying base policies for her 2 kids. She's making both of her kids 50-50 beneficiaries. It's not a joint plan. They're each going to have base MoneyGuard policies. But when she dies, assuming she hadn't used any long-term care benefits, each child will have the choice on what to do with their portion of the death benefit. They have to have their own MoneyGuard policy. But if they do, one kid could say, you know what, give me my portion of the death benefit. The other kid could say, I want more long-term care. So options beyond married couples, the ability to have customizable policies, and no decision until the time of claim.
Hey, Rob, pause for just a second.
Yeah.
You're doing a great job of anticipating the questions, by the way. Phenomenal.
Yeah.
Guys got a lot of questions about joint
Good.
policies, and some of the competitors, have come out with some joint options. So this is a
Yep.
different way of thinking about a similar concept. How would you position it? Let's say you're going up against a nationwide second to die
Mhm.
Care Matters 2 policy.
Right.
How does this kind of compare, because it is a new concept, so it takes a little bit of getting our mind
Yeah.
around it, but I think it's got a lot of flexibility. So I'm curious what you've seen.
Yeah, and I think it comes down to the max Care Matters together is 8 years. This is for those folks that, hey, I want to have different benefits. I want to give her a more robust policy than him, because we could do 6 years and 6 years, or 6 years and 4 years,
Mm-hmm.
and still have that flexibility to transfer an unused death benefit. I think when it rolled out, people looked at it like a shared care, and I'm hesitant to call it like a shared care because we're not sharing the LTC benefit, we're sharing the unused death benefit. Now, the good news with Lincoln, that death benefit can never be less than what we paid in. So we're going to be able to elect, do we want to enhance our own policy?
Mm-hmm.
With the Care Matters Together, Joint Life, One America, you're deciding today that you want a second to die, and you have no flexibility when one person dies to get a death benefit. This is what, hey, I want the option of making a second to die or choosing the death benefit.
So there's more
And I think-
customization, and I like that
Yeah.
idea of having like the parent-child option, especially when you can buy a smaller policy and kind of give them flexibility, almost like a buy up later, if you will.
Yeah, and the minimum policy, and I get asked this, what is the minimum? It's just enough to support a $50,000 death benefit. So,
Okay. And
And-
someone had asked about death benefits, 100% tax-free in that situation, or what?
it would be.
Okay.
So, and you can illustrate this in the illustration software. If you want to say, hey, what would happen to my policy? If my husband died, what would happen to my policy? We can illustrate that today. Now we're guessing on when your spouse might die and how much death benefit is left. But we can illustrate that we know exactly if your husband dies and you're age 85 and there's this death benefit, I could tell you to the dollar how that will impact your LTC benefits down the road. So if the death benefit, and the death benefit gets reduced dollar for dollar, right? If the death benefit were reduced dollar for dollar and it's under 25,000, we're just going to pay it as a death benefit. If it's long as it's at least $25,000 or more, they're going to have the choice on what to do with those dollars. So other questions for me, and again, this is built in. Folks say benefit transfer provider, what does it cost for this flexibility? This is in every MoneyGuard fixed advantage policy.
Right. When somebody's, just another follow-up question, when somebody's getting the death benefit and wants to add more to their policy,
Yep.
are they purchasing it at their attained age at that point, but it's guaranteed issue, or how does that?
No, it's at the original rates that they had in the policy. And let's say husband died, right? Wife's 80 and she had $700,000 of LTC at that time. We took his $100,000 death benefit, we leveraged it by 60%. We had $160,000 of her bucket of money, and now her new bigger pool compounds. So she grew her pool, and now the new bigger pool compounds, and we compound even when they're on claim.
Okay, so the LTC benefit is dollar for dollar from the death benefit, but then it increases at that point with inflation.
Right, yep.
Okay.
The LTC is leveraged by 60%, so we'd add 160,000. She had
Okay.
800,000 now, and she's got 960,000, and we compound 960,000 by 3% every year. So the new bigger pool compounds. Again,
Okay.
this doesn't cost any money. Why not give clients the option down the road, depending on their situation? Maybe the spouse just says, give me the 100,000, take it. But if we could give the spouse the option to get more long-term care, this is that flexibility.
A couple other questions, not quite related. One was, do you guys accept qualified or only non-qualified dollars?
Only non-qualified.
Okay. And then one other thing is if you go back to the separately identifiable premium,
Yeah,
that was actually pretty shocking to me. You had 85,000 was LTC out of $100,000 premium. 85% of the dollars were LTC.
yep.
So my question, given that the plan designs are, the same as the competitors were, this is on like the one where you're comparing it to your unnamed competitors, like the
Yep.
three there. Is it because you guys are treating the acceleration as LTC instead of life insurance, whereas the other ones are treating it like life insurance? Because it's just surprising how different it is.
Yeah, it's a significant, it would be that reason.
Okay.
Yeah,
Okay. I'm gonna have to tell my dad that because he always said, "Oh, there's only a smaller percentage of premium that's LTC." Well, it depends on how you count it, right?
right.
If you count as LTC, then it's more LTC, and that's what you're showing with that deductibility. Now it makes a ton of sense to kind of put it in that bucket.
One other note, we pulled back, we were using a Lumifin for our PHIs. And I know a number of the carriers use old LTCG, a Lumifin for their PHIs. We've pulled back from them. We're doing PHIs in-house now, except California where we still have to use a Lumifin. So it's a Lincoln employee that's doing the PHI interview. We've also moved to defaulting if they're 60 and younger to doing an online PHI versus a telephone. Now, if they want to do a telephone one, they can. For my money, what I did, I would do an online one every time because you can start and stop. But we're defaulting to online. We're finding, such a higher percentage of our apps are online anyway versus paper now. Folks would rather have the flexibility to just answer the questions at their own schedule and be able to start and stop versus the pressure of a telephone phone call.
Phyllis,
And
I saw
all
you
ages
had,
can do an online PHI. It's just if they're 65 and do an online PHI, the cognitive is a standalone 15-minute.
Okay, I thought Phyllis, you came off of mute and you had some comments in the chat. Did you want to add something? This is pretty exciting.
I thought that was first off a great move, Rob, about doing it in-house. I just think
Good.
that's a wonderful move. And then 60 and up to let them do it online. Yeah, all those are great. All those are great. I wanted to parse that international one more bit here.
Yeah.
If somebody elects the 80% in
Yep.
a country, that could be important about qualifying the facility. So, what kind of licensure and all that? Did choosing indemnity be helpful in a foreign country as far as getting a facility approved? Does that make sense?
Yeah. I don't run into a lot of international facility care claims just because I don't see it on the back end like that. I guess I would ask you, when you have international claims with other carriers, how do they determine that facility is a
Qualified. Yeah.
Right.
I don't even think we've gotten that far. We've been focused on how do you get it approved, a US doctor, and is it going to be telehealth or does the doctor
And Phyllis, I think
Yeah.
the difference is that when we're talking about an international carrier with cash indemnity,
Mhm.
you just have to meet the ADL triggers and be certified by a licensed healthcare practitioner. So it's who's the licensed healthcare practitioner. They don't care where the dollars go, because they're not looking at licensing for anything for home care or facility. They're just
Yeah.
paying you cash. I think
Mhm.
with this, it's a little different because it's not a cash indemnity. It sounds like you also have to have a licensed provider and that has to be certified. Is that correct, Rob? Or
You have to be in a nursing home or assisted living. I would say in the
Okay.
US, it's cash indemnity, but
Right.
internationally, you have to be in a facility.
Okay, so there may be an additional requirement, Phyllis, just to validate that or to verify that, whoever the provider
I will
is.
find out for you though. I
Okay.
will contact my claims and get clarity around that for you.
Cause I've been doing this, a one document with all of the international benefits, cause we're getting so many more inquiries from
Hmm.
people wanting to move outside the US, so we've gotta have this nailed down.
I will get it for you.
Okay, great.
And we
That's
could
a
even
lot
do
of
it.
improvements.
Yeah. So I think, yeah. Yeah, and I pull back, I look at the big view. Hey, if I'm able to offer a really high monthly benefit, give them the flexibility at the time of claim. Is it perfect? Would I love for them to be able to flip flop back and forth? Sure. But the trade-off of having a high monthly benefit and no elimination period and that choice, I think is a good thing. So I'd love to
Yeah.
have lower premiums. There would be a lot I'd like
And
to have, but
like Mark said, Rob, the higher amount that's identifiable as long-term care insurance
yeah.
or, executive carve out or whatever, yeah, that's huge.
Mhm.
So
Rob, a quick question as well. I know that you had a lot of growth in the last couple of years with the MoneyGuard Market Advantage, and now that you've
Mhm.
repriced the Fixed Advantage, are you seeing any kind of change to like what sales distribution on the Market
well, I
Advantage
mean,
versus Fixed
the
Advantage?
fixed advantage is a higher percentage because we weren't as competitive before in the fixed space. Our total number of applications, if we look at Lincoln between brokerage and institutional, we're still at about 55% fixed and 45% market advantage. Because our friends in the Ed Jones, Merrill Lynch, UBS world still write significantly more of the market advantage than they write the fixed advantage. I will say the market advantage actually had the indemnity option introduced last year, May of last year. So it already has the indemnity option. It just does not have the separate life and LTC premiums. So
That's interesting. So
in
you
brokerage
have
world,
shifted back towards the fixed, it sounds like then.
yeah, in brokerage world where most of us work, like myself, I'm probably 85% fixed and 15% market advantage. Average buyer of our fixed right now is 60. Average buyer of the market driven version of MoneyGuard is 50. So
Right. It sounds like it's still in that wirehouse channel.
yeah, it is primarily. So
Interesting.
any other questions for me before I jump off and allow you guys to have your time back?
No, this has been great.
Transferring old policies to new policies.
Yeah. Thanks for Phyllis.
That's right. Yeah, Lynn had asked another question. Sorry, Lynn, I
Yeah.
forgot to ask
That's
it.
okay.
Say the question again, the phone.
So let's say you have a client that bought the old version and they like the new version better. Is there a way for them to upgrade that version or 1035?
No, it would
or
be
something
just
like that?
just like if it's rendered anywhere else, it wouldn't be in their best interest
Okay.
to exchange an old one for this one. They would still have that surrender value,
Right.
which would be an internal 1035 exchange. I will say we got a quite a bit of business where folks have a big 1035 amount, and some folks, what they'll do is they'll split that up. Hey, I want to use this portion for MoneyGuard and the other portion for a Lincoln Life policy. So we see that 1035 exchanges are about 1 in 3 of my MoneyGuard cases right now. It's 34% is an external 1035 exchange from another carrier.
Interesting.
And then
So-
they surrender that policy.
Yeah.
Rob,
Yep.
if you do a 1035 exchange, how do you keep the long-term care, the life insurance tax-free? Just the death benefit is gonna still be tax-free?
The death benefit would still be tax-free and the long-term
Okay.
care would be tax-free.
Gotcha.
Yep.
We had also had quite a few people that asked for the attachments. You did a great job. Thanks for preparing,
Yeah.
providing all those great media attachments. We'll forward them out after Rob sends them over to us along with the recording. So thanks, Rob, and thanks, Gretchen.
Yeah. I'll email it to both of you.
Great job, Rob, as always.
Thank you so much, Phyllis. Thank you, Mark, and everybody on the call. I want to just share my direct number. And I know some of you might work with an agency that's my responsibility, and some might work with a different MoneyGuard wholesaler. Either way, I'd love to help all of you. My direct number is 651-592-6643. Again, 651-592-6643. That's a Minnesota area code. And I can't wait for my kids to go back to school tomorrow. So,
Amen to that.
but thank you, everyone. Appreciate the opportunity, and thank you for the business.
Appreciate it, Rob. Thanks so much.
Have a good one.
Sorry, go ahead, Rob.
Yeah, just thank you again. I'll jump off.
Okay, thanks. Yeah, and I put Rob's contact information in the chat. So if you didn't jot that down, I jotted it down for you. So feel free to copy and paste that in to your on your computer. All right. Well, that was really exciting. So I didn't mention this, but Gretchen and I kind of took over the study group today because Jason is actually out on a well-deserved vacation. He will also be out on Thursday, but we will be hosting the worksite study group, and we'll be covering some case studies and some one-pagers on sample proposals that you can use with clients there. So don't miss out on that. Anybody else have any questions or topics they wanted to bring up? It doesn't have to be related to Lincoln or Gretchen. See you unmuted.
I did. Only to
Yep,
answer
okay.
questions,
Oh.
but I will tell you, I'll give you a little sneak peek. If you're in the portal, we have some changes. They're live in the marketing section. But we'll be showing them. Oh, you're going to show them anyway.
Well, you can't tease and not show.
Yes, I can. I'm in marketing. God.
Oh, man.
Oh, come
Go
on,
ahead.
say it.
Well, I can hover over it and be like, oh, look, it says new. There's something there.
Go ahead, click on it.
Okay.
So there's recommended content now. So you'll see that at the top, and so Mark, if you click on the individual tab,
Hold on,
nope.
I haven't had a chance to test it. Let me move this.
Oh,
over.
over on the left
Okay.
group. Yeah.
Oh, cool.
So it changes depending on whether you're focused on group or individual. And then the other piece of this that isn't showing right there, but I'll set one up for Thursday for the demo, whoever's going to be on the Thursday call. You also have an opportunity to pin your own content. So right below recommended content, if you pin something yourself, if you like something yourself, it'll show up right below that. And it'll say, I think it says your favorite content or something like that.
Okay. So like
So-
this little button in the corner here.
Yeah. But I need to, oh, it is working. I hadn't tested that part yet. Yeah,
Okay, not yet.
not yet. Yeah. So, so by Thursday, it'll show pinned content, your own pinned content. So,
This is great.
yeah, very
And we
exciting.
have a lot of great information in the marketing section that you can use, present to financial advisors, present to clients. But we want to make it easier to find kind of those best pieces, recommended content, and allowing you to kind of pin your contact. So that's a great enhancement. Thanks.
Yep.
Y'all, I have to say, I love that piece Rob had about identifying the assets. Sign off on it now that you're going to use to pay when you decide to self-insure. That's one more arrow in our quiver.
Mm-hmm. Yeah, and the way that he's approaching it in a client-centric way, as opposed to making people feel guilty that they're not doing something, I think that's a subtle but important approach to
It
it.
also covers your tail if something ever happens,
Right.
which it has, you know. The
Yep.
kids want to know, where's my money?
All right. Anybody else have any topics that they'd like to cover or questions? All right. Well, I'll give you guys a few minutes back. Thanks so much for all the support. We'll talk to you guys soon.
Bye.